welcome to another episode of Always Up to Date. I'm Denise and this is Yahweh, and we are co-owners of Always Bookkeeping. Today we are going to talk about tips on how to read your financial statements. So if you have watched us before, you know that we like to start the video with a quote and a statistic and just a small story. So today our quote is from Michael Gerber, who's the author of The E-Myth. His quote is, "The entrepreneurial mode has less to do with what's done in a business and more to do with how it's done. The commodity isn't what's important, the way it's delivered is." And the statistic that we have today is from Intuit, who are the makers of QuickBooks. They did a survey on small business owners and quizzed them on some basic business financial literacy questions, like the role of the balance sheet, accruals, how to improve cash flow. 82% of the respondents scored less than 70% on their test. So Yahweh, you have a little story or experience that we've had in our experience?
Yeah. This is very common, especially when you're starting out. You would hire even if you're doing your bookkeeping yourself, you would do all the recording, all the bookkeeping, but then you get to the end of the report and you just don't know how to interpret these reports. So some of us don't have enough
knowledge?
Not knowledge, but not just resources on how you would gather this information or how would you analyze this information or any help really, right? And most of the times the business owners are really good at their business, but the accounting side of it or the business side of it, we mostly need help with. So our goal today is just to give you some advice and hopefully some tips on how you can easily analyze or read your financial statements.
Great. Yeah. So Yahweh, I have just a few questions for you that maybe you can answer. So first of all, what type of report should I receive from my bookkeeper? So
most of the bookkeepers now should be able to give you a balance sheet and an income statement at least. The common accounting software generate this very easily now, and they don't have to do it manually and organize it themselves. So they should be able to give you guys a balance sheet or an income statement. Now, if you have a long list of clients or a long list of suppliers, you might be able to ask your bookkeeper to organize you an aging accounts receivable summary or an aging accounts payable summary. That would give you a better description of who owes you and how long has it been outstanding, or who you owe and how long has it been outstanding. And then another one that could be given to you is a cash flow statement. Very rare. Most of the stuff you can probably gather from your balance sheet and your income statement, especially for small businesses that are just starting out.
Great. So what report should I look at first? Does it matter?
I believe it's very important to look at your balance sheet first, and the contents of the balance sheet, we have another video that would tell you all about what should be in it. But really, if you look at your balance sheet first, that would tell you your financial position on the business. So the listing of the asset first, of course, and then it'll tell you how your finance or how you're are able to maintain the assets. So are you financing it, or are you taking it out from your equity, from your own household or own contribution, as opposed to your company making the profit to be able to sustain these assets? So it is very important to look at that at first, because you want to first of all look and see if you're on a good financial position. I know as a business owner, you always want to see the profit and loss first, just because it tells you how much or how well you did in your business. It's kind of like a validation. But looking at the balance sheet first and being able to find any anomaly on the balance sheet will give you a better chance of having a more accurate income statement, because the chance that your balance sheet is wrong will give you a bigger chance that your income statement will be wrong as well.
Right.
So it is very important to look at your balance sheet first and then go to the income statement. Yeah.
So I know we do our reports in a comparative monthly format. Why do you do that? Is that advisable to do that? Is there a reason for that?
Yeah, for sure. We like to do it comparative monthly financial statements just because it tells you kind of what happens in a month, and it kind of eliminates the factor of seasonality. So if you just looked at it on a total basis, yes, I could get some information from this, but by doing it on a comparative basis, you would be able to tell any inconsistencies or consistencies is your business, and are you able to explain this inconsistencies first of all, right? So those are the stuff that you want to point out when you're doing comparative analysis, and it is very advisable, especially for the balance sheet, because if you look at the balance sheet, you just see how much the equipment is. But if you look at the comparative monthly balance sheet, you'd be able to tell at what point did you buy an equipment, at what point did you have a low cash month, like is this something that I should be looking at in the future, or is this something that I should be taking in consideration when I'm making decision. Again, seasonality, if you see you have a low cash in March, maybe you have 3 payrolls in March, and you have to prepare for that the next time because you might run out of cash flow.
Yeah. And sometimes, like I've seen a lot of clients that you're looking at your income statement and wondering why your payroll is so high all of a sudden. And so if you're looking, and we normally do 6 months, compare 6 months. And so you can see, because 2 months out of the year, you're going to have 3 payrolls instead of 2. So in those months, you can see that, your payroll is a little bit higher. But if you look at the other months and see that they're all consistent, then you know that that month is one of the ones that is the 3 months. So it is. You're right, it is good. So should I look at the balance sheet even though I haven't made any big purchases?
Yeah, absolutely. Again, your balance sheet tells you your financial position, so you should be able to look at it on a more frequent basis. Even if you didn't make your any big purchase, because again it lists all your liquid assets on what funds are available for you currently right now, and looking at that, it also gives you your current liabilities. So anything that you have to pay within the first year or even the first month, right? So it should be able to tell you what you should be looking at as far as allocating your resources, especially cash. And again, most of the businesses run out or exit the economy just because of they run out of cash. Not necessarily that they're bad at it, just because they have a really bad cash flow management. And a good cash flow statement isn't always available. So a balance sheet should be able to tell you where you're at financially. Yeah.
Good. So how does a balance sheet tell me if I'm losing money from possible theft?
So, and this is a good question, because there are a lot of accounting software that use undeposited funds. So if you were looking at your cash state or your balance sheet, all your bank accounts you can reconcile, but your undeposited funds, those are the ones that you don't necessarily see in your bank yet, but sometimes you don't check if those funds are actually available to you. So your petty cash or any checks that have not been deposited, do they exist? Would you be if your deposited funds is growing exponentially on a monthly basis, it might be that you're losing money through theft because these cash are not actually available to you. They're not hitting the bank, but are you seeing them on your cash register? Are you seeing the checks in your safe box? So those are the things that might be able to tell you, am I losing money because of theft? Especially if you have another employee that's non-arm's length, right? Yeah.
Oh, good. Will my balance sheet tell me if I'm going to have a cash flow problem?
Yeah, again, your cash and all your liquid funds show on your balance sheet. So it should be able to tell you at what level of cash you're at. And if your accounts receivable isn't there, then if they're both at a low level, then your liquidity just goes really, really down, right? So that should give you a signal to say, hey, I need cash this time. Will I need financing in the next couple months? Will I need to contribute again to my business? And so those are the stuff that you want to look at if you're looking at your balance sheet and income statement.
Yeah. Great. So what should my income statement look like?
Your income statement should look like, first of all, it should fit all in one page. If you can't fit it in one page, especially for a small business, it would be a lot harder to make your decision out of it. Chances are you're gonna have a lot of extra expense accounts in there or revenue accounts in there that doesn't necessarily have to be classified separately. And it is very common for us, especially in our industry, for the accountants, for the bookkeepers, to be really, really what's the term? We want to be very accurate, and we want to be very consistent to the point that we're categorizing each one as a separate accounts, just to show you that we know what it is. But really, you just want to be able to have a simplified income statement that would tell you what account is really affecting my my revenue. So your revenue should be, it could just be one line, and in the max, we recommend just having 3 categories that would explain your revenue. And as far as expenses go, you want to go numerically descending to see which expense accounts are actually affecting your revenue or your bottom line, or what's driving your cost. Sometimes you will have cost of goods sold, especially if you're a merchandising company. So those are very important to look at too. They should be relatively growing or decreasing when your revenue grows or decreases as well. Yeah.
So Yahweh, you mentioned about numerically descending for your expense accounts, and so what's the value of that? Why would you do it numerically descending?
We as business owners, we try and make our expenses as low as we can, but to the point that we're gonna look at the bank statements and see who could give us the better rates, who could give us the better interest rate and stuff like that, right? But if you look at your expenses in a numerically descending order, you'd be able to tell which accounts I should be looking at first before I even go to the interest and bank charges or your utilities. Maybe my rent is very high that I have to focus on how I would be able to maintain my business just by keeping my rent or my supplies. If I need my supplies that much, maybe I should be talking to my suppliers as opposed to spending so much time on a bank statement trying to lessen your bank charges. So those are the things that you might want to look at if you're looking at it in numerically descending order. The biggest ones are the ones that really matters on your business. Yeah.
So what will my income statement tell me on a monthly basis?
Yeah, so comparative monthly statement would be able to tell you any seasonality on your business.
Mm-hmm.
We talked about the payroll before. We talked about seasonality. So if your revenue is having a higher revenue stream on 1 month, maybe you should plan on advertising for that month. So stuff like that would be able to give you a clue on what you should focus on seasonality or any one-off expenses that might not show up every month.
Yeah. Right. So does the income statement show how my expenses affect my income?
Yeah, absolutely. So again, one of them would be your advertising. Like if you'd be able to tell if spending on advertising is actually increasing your income on a monthly basis, or maybe it takes a while before your revenue shows up from this advertising initiative, right? So stuff like that you'd be able to tell just by looking at your income statement. You don't necessarily just want to go on a comparative basis, which is what we call a horizontal analysis. You want to go vertically as well. Is my payroll, or my for service industries especially, is my payroll justifying how much I am generating if I'm charging in the hourly basis, right? So those are the stuff that you want to look at as well on a vertical basis on your income statement.
So Yahweh, is it beneficial to look at a monthly income statement if my business is seasonal?
Yeah, and I think I talked about it a lot. I think I got ahead of myself. Yeah, so again, the one-offs, it would be able to tell you if it's a comparative monthly statement. Let's say you spend big on advertising this month, but you won't necessarily do it every 6 months. By looking at it on a monthly basis, you'd be able to tell that I might not consider this factor in deciding on my day-to-day basis or month-to-month basis. So just knocking those one-offs out of your decision-making process just makes it a lot easier. Yeah.
Great, Yahweh. That's all the questions I have. You've had a lot of information for tips on how to read your financial statement. So thanks for answering those questions.
Hopefully you find it helpful. If you have any questions, feel free to comment and subscribe onto our page, and we'll get to you as soon as we can. Also, please hit like and subscribe if you enjoy watching our videos, and we'll see you guys on our next video, hopefully.